Okay, well, thanks for joining us for this month's Finance and Insurance Committee meeting. I'm Mike Sisto, the chair of the Finance and Insurance Committee. And what you see, if you can see it at this time, let me know, is the agenda for today's meeting. And it's on screen. So call to order and roll call, review of the treasurer's report for July. Budget discussion and planning to kick that off. Any other business? We just added one item, but I just have one item to add, and that would be the risers and the provisions for that. Uh, Sean Flynn sent us an email. I circulated that to the finance committee, and Sandra's looked into it as well. So just have a roundtable discussion on that, and then adjourn the meeting. Anything else to add or comment? Okay, great. Great to have all you guys at the meeting, and hope your summers have been great. Okay, so if I look at the first item, the treasurer's report. So again, just to do a level set and put everybody on the same page. We received the monthly financial package from First Services. And when I was last there was discussion around a lot of the members, or not a lot, but several of the members saying that it was a bit complex. There was a lot of information, and the typical feedback was, well, it's all in the financial reports, but they're a bit cumbersome to go through if you don't know what you're looking for. So we prepared this presentation layer to really, for the non-finance people, to have a snapshot of really where we stand from three dimensions. One being the income statement, the operational income and costs. The second one being the balance sheet, what we actually have. And the third is how we're spending against projects, which are the reserves and some of the activity there. So if can you all see the first page of the report, which is the operating income and expenses? Silence is golden, so I assume it's yes.
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 So you guys are familiar with finance, so I'm not going to give you a crash course on it, but on the top part are the revenues, and I really try to simplify it into three or four lines. And the revenues really are the maintenance fees and what we collect for contributions to the SERS and non-SERS funds. And on the expense side, we have six categories and how we're tracking. So the left-hand side is the last year's spending, or the first column is last year's spending. Then the July year-to-date actuals and budget and variances to those amounts and the budget. Remaining budget, and then I take the liberty of adding some or inserting some comments in here just for clarification or what I see. So on the revenue side, if you look at the year-to-date actual, it's 4.19 million compared to 4 million, which was the budget. So we're tracking a couple of 100,000 higher, and that's primarily for the interest income we're generating on some of the cash. And some of that cash or some of that interest income gets transferred to the reserves, but that's only done later on. And on the expense side, our total operating expenses for the first 7 months is 2.8 million, which is pretty much right on budget to 2.807. So we're tracking pretty good. However, I just want to highlight a couple of things. One reason being that we're making gains on the amounts we had estimated for property insurance. And, we had a discussion on insurance earlier this year, and we were expecting savings, and those savings are actual savings that will happen this year. They're kind of being offset by, if you look at administrative and others, 66,000 unfavorable variance there. So our legal fees are 56,000 over budget, and professional fees are 40,000 over budget. Now, one can make the argument that maybe some of those professional fees are related to studies in terms of projects, which should be capitalized or go against our reserve spending.
Mm.
But there's the old adage in accounting, expense what you can sooner
Yep.
than later. So there's always you know, so we
Yeah,
can look at that
I,
over the coming months, and maybe during the budget exercise, and maybe even set a guideline as to what we capitalize and what we expend.
I
And
I agree with you, Mike. Even if you put it against the reserves, then you have to reevaluate the reserve and see if we have enough for the
Yeah.
search. So honestly, we have to, I mean, I prefer that we keep it at expense, but we have to really look at how we budget and make sure we have them as part of the budget process so we don't have surprises.
Yeah. No, that's well summarized, Katina. I think we're pretty much on the same page there. The legal fees is a bit of a black box for us because we're not privy to the information on some of the board's discussions related to legal matters. So, Aski, we put that in your good hands to be the custodian of that. I guess there's more legal activity than we planned, and hopefully
No, it was
for
part
the
of a
benefit of the
settlement.
members.
It was part of a settlement that the lawyers, even though they lost their cases, they sued for legal fees. So we settled with some of the plaintiffs' legal fees.
So
So,
would we expect that to go down, Heskey? Is the matter resolved?
The matter has been resolved to our favor with
Okay,
zero culpability for Playa del Sol. The plaintiff is attempting to reopen the case and file an appeal, but the plaintiff essentially got $0 out of a 800 something $1,000 claim, and she was the most culpable person among all the parties. So that's what it was, a jury trial, and that's what the jury found.
okay.
So are the legal fees our attorneys or something that?
Yeah, our insurance, we have officers and directors and officers insurance. So, to protect, to defend ourselves against all these lawsuits, we haven't had to spend money. But in this case, to pay the plaintiff's lawyers, that was for the derivative case that I won't mention any names, but a person brought against the board for the board, not fulfilling its fiduciary duties in certain aspects.
Right.
So we were liable for that. It was a derivative case. So in the
Okay.
derivative case, we had to settle for the legal fees, but we're not going to
Okay.
have to settle for the legal fees on the regular lawsuit.
Okay,
yeah,
Okay, well, I guess, Heskey, it's very good news that we settled
Yeah.
the litigation and that the judgment was in our favor.
yeah.
Of course, there's some collateral
And
legal associated to that, and there's maybe derivatives as well, but it sounds like the bulk of that legal activity has happened and should diminish in the next few
Yeah.
months.
And
Unless
and
other stuff happens, right?
and the insurance of the directors does not cover the legal fees?
Not in that case, but it covers
Okay.
or it's covered years of legal fees
okay.
for us.
For the derivative, the association's insurance covered legal fees for the derivative, but not for the settlement.
Okay.
And then
Okay, got it.
and
Okay.
then for the second lawsuit, as Heskey was, Playa del Sol was found 0% liable, and because of that, we were able to submit with the court for all of our legal fees for
Good.
the case to be reimbursed, which has been submitted to the court. Our attorneys have done that already. And as Heskey said, also the plaintiff filed to reopen the case. So it's just kind of a waiting game now to see what happens with all of that.
Okay, good discussion. I'll move to the second page. So the second page is the balance sheet, really summarized into really four main components on the asset side: the cash for operations, what we have left for special assessment, and for the reserve funds. Then we have accounts receivable. I had a discussion with Sandra. We'll reclassify that. Those are really the bulk of that is receivables from members. And then prepaid insurance and expenses and all other. And you can see there's not very much else in all other. So all in all, we have 12.6 million in assets. up slightly from last year, which was just about 12 million. And on the liability side, we have the insurance that we have to pay. The deferred revenues are really the maintenance fees we collect in advance.
Yep.
In this case, cover August and September. And then the other bulk of the spending is really the reserve special assessment, the SERS and non-SERS, which I'll cover on the next page.
Um,
The members'
oh,
equity shows as 561,000. Now there seems to be a 40 or $45,000 discrepancy there related to that, the figure used in the financial services reports, Scott, and what the audited financial statements had. Sandra's working with yourself, I believe, on that, and completing also some of the other journal entries. So if Sandra and Scott, you want to just comment on that and see where we're headed with that?
As far as that members' equity, I did have a phone call with Gloria yesterday, and she felt like there were in the adjusting journal entries, Guy had expensed certain items where First Service had accrued for. So they didn't get accounted for correctly, and that's where she felt that discrepancy is coming from.
so it's a prior period adjustment?
I guess it would be a double accrual as of December 31, 2024, if I'm understanding correctly.
Usually if you have a double accrual and you reverse it, it reduces the expense of 2025. So if you had over accrued expenses in 24 at the end of the year, and then you reverse it, it goes into the P&L. It does not go into equity.
No, exactly. You should see a gain in the subsequent period, which in this case, I mean, I don't want to get into details here because it's under the good hands of Sandra and Scott and Gloria. But to your point, Katina, then in this case, we actually should see the members' equity going up, not down.
Yeah.
45,000.
I mean, if you look at,
so it's kind of, yeah. Let's get to the bottom of it and either reconciling item or something.
okay, the only change in equity should be the loss of
the current year.
last year.
Yeah.
The loss of last year and
Yeah.
the adjustment so far year to date of this year,
Yeah,
because
so if you look at that, Katina, last year we had 916, which included a loss of 300,000 last year.
yes.
So it brings us to
So
560. It should be 515 or 615, sorry.
okay.
I mean, Scott, I think at this point, we probably want to tell Gloria to just go ahead and book.
Fix it.
Make the adjusting entries and let's move on. I mean, you know, there's no other alternative. We got to make it match the financials, the audited financials.
Would you do me a favor for a second? Can we go to the income statement?
It's 10,000 loss if that's what you're trying to.
Yeah.
Yeah.
So our equity from last year to this year should only change by 10,000, not 500,000. It should be 916. It should be 906.
Katina, it's actually the 12/31/2024 is 616,989 because there's I think we're going to correct that for the next one.
Okay, but then what?
I screwed up, Katina. It was supposed to be. I was taking the information from First Services.
Okay.
The 916 that includes the three. That includes a portion of operating, which shouldn't be there, right?
The interest. It's the interest on the
interest
that's in there. Yeah. So we're going to remove that. That was there. That shouldn't be there. So it's really 616 as of 12/31/2024, which should be reduced by 10,000 lost for the current year.
Correct.
And 606. So I think you know, that was the point with FSR with Gloria in the accounting department. You know, we just got to move and book the adjusting entry. And Scott, I can help with that. Let's just maybe try to schedule something with Gloria.
Okay.
Try to get that. I mean.
Also, Mike.
Yeah.
You know, last year's budget as a source of income, as a source of funds, we proposed to use $175,000 of our owner's equity. So
Correct.
what First Services does is every month it adds that as a cash receipt. So
Hmm?
1/12 of that 175, they add as a source
Oh,
of income.
okay.
Why, what kind of accounting is that? If we want to use owner's equity, then what we do is we're supposed to run a loss, and then that
And
loss
then take it
goes
out.
into member equity. You never, ever book journal entries to equity. Never.
Yeah, well, that's what they do. If you look at their
No.
financials, you'll see.
I think that's for tracking purposes, just so that they can have a $0 budget. So instead of having, when we did the budget, that's just for tracking purposes. You're not going to see that you're going to have a loss when you have your year-end financial statements, and then it's going to go against the equity.
Yes,
But
exactly.
for tracking purposes on a monthly basis, they're showing it like that so that you have a zero budget.
So they're not actually journalizing that, they're just showing it for information.
No, they are. It's account 40095.
Okay.
Yeah, that's where that's
Yeah. Why not budget it that way that it is a loss on the P&L, and then they don't have to play with journal entries?
Okay, well, maybe that's the correct way of doing it, Katina, but this year
Okay.
we've got sharper financial minds than me, so we'll get it done the right way.
No, I mean, usually you don't book.
No, we weren't suggesting. What we did last year was, look, we came up with an operating budget and said, we got like 900,000 of, I can't remember what the figure was, but 890,000 of owner's equity on the operation side. What for? So let's deplete some in the budget so that the increases are less significant than they were. So that was the mindset behind it. Now the mechanics on how you do that.
Yeah. Or what I would do is say, put it in the reserves for future use, because we're going to need it anyway. Yeah. I would not, I wouldn't balance, I wouldn't deplete equity. As long as we have it, we need the reserves for the building. Yes. So, and if we have it, then we don't need to do special reserves, which is a good thing.
Yeah. Okay, I'll move to the third page. So that's really, this table highlights where our spending has been in the three categories: special assessments, SERVS reserve fund, and the non-SERVS fund, by showing the balance at the end of last year, the cumulative balance of monies spent or monies put aside. And then what we've actually incurred for this fiscal period from January 1st to the end of July. And that really has two components, really what we're bringing into the reserves from the assessments, but also what we're depleting from the reserves, or what money we're spending for projects. So, and that brings us to a cumulative total. It says June year to date, that should be July year to date. So if we look at special assessment, we had 4.8 million at the end of last year. This year we've depleted that by 1.4 million in terms of spending on essentially the concrete restoration, and the elevator maintenance projects, along with the related PM and engineering, leaves us with 3.3 million that sits on our balance sheet. And that 3.3 million is made up of whatever we received from special assessments and transferred from the reserve fund, less what we spent. It's not rocket science. Now, one question that Sandra and I had was that, for example, on the concrete restoration, I added the contingency with that project. I don't know if that's 100% right, Scott and Heskey, but I don't know where that contingency ended up or what it was for.
Well, it's in there because we owe. So you're saying we have how much in our special assessment there?
4.4 million.
Okay, so we owe this TKE another million, a little under a million. Wow. So that leaves 3.4 million.
But we've spent this.
4.4 is what we spent.
Yeah, we've spent it already.
We're at 3.4.
That should be spent on accrual. Now,
So
what we
we're
pay-
at 3.4. No, I mean, what's about?
Okay, so we at the end of last year, we had 3.4 million
Left over.
left over.
Or no, we
No,
had
that's spent.
3.4
That
spent,
was
spent.
spent.
Right.
Plus, this year, we've spent another 974, so the cumulative at the end of July is 4.4 million.
So that's
All right, but
concrete.
well,
That's
what's left in
concrete.
there?
That's the
What?
concrete.
There are too many questions going on. Heskey, what's your question?
Well, we basically have 2 million for we earmarked for roofing, a million that we still owe ThyssenKrupp, and there was 400,000 originally left over from the concrete restoration contingency. We're chipping away at that for engineering fees. So we're paying for some engineering. We had to re-engineer the roof. So we're paying a little bit for project management from that. So Scott, divvies it up. It's not all coming from our operating expense. So where we can, we're deducting engineering from our special assessment account, and so we have about $350,000 left from that contingency. So we have 2 million plus 350,000 plus $1 million that we owe ThyssenKrupp. So that should add up to 3,350,000.
But
Okay, so
I'm
when
confused.
you say we have to pay,
Yeah.
have the expenses, have the costs been recorded? Paying is one thing, recording the cost is another. Have the costs been recorded, Scott?
Have what? I'm sorry?
Have the costs for the concrete, all the costs for the concrete restoration?
No, we're talking about we have to pay for the
No,
elevator.
but we have to pay somebody, and what we record are two separate
So,
things.
there's nothing outstanding on the concrete restoration.
Okay.
That's all been.
So the 440 is fully complete. Our obligation is complete.
Yes.
Okay, and that's
Are you, Heskey, are you in accordance with that? Because what I'm hearing from you is a bit different.
We don't owe any, we're done with concrete restoration.
Okay, that's good.
That's
So
good.
now the elevator, the
Wait,
budget.
just before we move on to there. So we had 4.4 million here. It's complete. Our project budget was 4.9.
Okay.
Can we use that excess for other projects? Or does that have to go to a vote or something?
Honestly, I think that should be done. And if we have other projects, we need to put them up and put a budget for it.
Well, it's in there just in case we need it for the roofing, because it was a
Right.
contingency.
Okay.
The
So,
roof is not.
Yeah, we don't have a hard number on the roofing. We just
Gotcha.
we have a placeholder. So
Yeah.
that's why it's there.
So
So
why
the
not?
roof where we have a budget of 2 million, you're
Right.
saying that with the contingent, with that excess we have, we're closer to 2.5 now, but we still don't know what it's gonna cost us, right?
Yeah.
Okay, got you.
Well, it's not 2.5, it's 2.4.
Okay.
Well, it's,
yeah. Okay. Any other questions?
No, it's 500.
I have a question on the elevators.
Mm.
So we're at 1.8, the budget was 2.7. This project's been a difficult one to say the least. Are we getting any relief from the vendor, or are we gonna have to pay more? Like, how does that project budget of 2,775 stack up against our latest projections?
We owe them $1 million. And we put them on notice that we're gonna hit them up for liquidated damages at $500 a day.
Good.
So I mean, it sounds greater than it is. I mean,
500 a day.
500 by,
I don't know when
It's
you start
nothing.
counting, it could be very little.
500 times 5 days a week, that's
Yeah,
2,500 a week times 50,
right.
2 weeks. So you're talking like $130,000 a year. So
Okay, does that mean they still continue charging us labor while the elevators don't work?
well, we haven't paid them in a while, so.
Well, but paying and charging are two different things. Are we obligated to continue paying them, or it's part of the contract we have?
It's gonna be part of the final settlement, I think.
Oh, So another legal battle.
Well, they've been put on notice, and it's clearly in the contract that we're going to hit it. You know, that's what they're going to owe. So that there's really no dispute in
So
that.
we're holding a 10% retainage from TKE right now on the contract price. There has been no change orders to increase
good.
the original contract price.
Okay.
And then, as Heskey said, we should be able to collect some sort of liquidated damages, whether it's they're going to agree to the full amount they owe us, or if it's going to take negotiating and getting 3/4 of what we're really owed. That comes at the end of the project when it's completed.
Okay, but we don't have a risk of the 2,725.
No, there should not be a risk of going
good. Okay,
that amount.
Good. That was my question. I'm not too concerned about the 175,000.
Can I ask a question? Is it possible to ask a question?
Yeah, sure.
Oh, hi, my name is David El Harara. We have a few apartments here. Chesky, based on what you said, the $500 a day, that's based on what? Why is it $500 a day?
That's in the contract, and that's what they agreed to. Going forward, we're trying to push our contractors to agree to $1,000 a day, because $500 a day doesn't hurt them enough. It's cheaper for ThyssenKrupp to pay the penalties and to pay overtime salaries for workers to work 6 days a week or come stay overtime. So it's not expensive enough for them to really do anything.
Yeah.
Going forward, we want it to hurt.
Yeah.
So ThyssenKrupp was contractually obligated to finish this project December 31st, 2024. So
24.
they're
wow.
8, 9
Time
months.
flies when you enjoy.
8, 9 months late right now. So that liquidated damages is $500 every working day after that December 31st date.
Okay, well, it's good, Heskey, that we're trying to put more into other contracts. I guess that would be relevant for the roofing project and all the other projects going forward. So good.
Can we estimate, by the way, the amount of damage we've had so far from the elevators not being set on time? Like, because if we can do that, if we can put a number on that, that will be very helpful later on when we come to negotiations at the end, when we need to, give and take.
Yeah, but I think we're restricted to the liquidated damages.
No, but sorry, I didn't get your first name.
David.
What David is saying, I think, Heskey, is we have that because they're going to come back and they're going to contest other things, right? So if we have that as a contingency, as a backdrop, then as they bring those things up, and say, by the way, we're only paying $500 a day here. It's cost us like 500,000 here, not
Exactly.
100,000. So I think that's the point.
Exactly. Like, for example, if we have residents that didn't make it to the meetings, or if we didn't make it to flights, didn't make it to certain things. I mean, we had actual real damages when we come to talk to court or anything like this. When we come to any kind of negotiation, that will be something that will be very helpful and definitely mitigate the problem.
Yeah, I mean, it's our attorneys are involved, and we do have a performance and completion bond. And we know we put the bonding company on notice. So yeah, we're not just relying on ThyssenKrupp. We have the bonding company, we have the liquidated damage clause. So like I said, all the chips will fall into place when we're settling our final payments with them.
Sorry, I'm emphasizing on this. We all know that, and I'm sorry if there's any lawyers here, but lawyers are useless unless there's a way to operate them, to push them in certain ways. Is there something that we can do from the side of the building to be proactive and make sure that ThyssenKrupp doesn't come after us for another $1 million after all this delay and all this nonsense?
Well, there's no change order. It has to be a change order that's not in the scope of work.
Right.
And we have no intention of not agreeing to any kind of change orders. They knew what they had to deliver, and that's spelled out. And if they don't, then we'll call in the bond.
I guess if David, if I understand what you're getting at, is there a way for us at Playa del Sol to estimate what the damages could have been, both from a cost point of view, extra cost, but also from a disruption point of view? You know,
Correct.
those are more difficult to quantify. The poor service that we've given our employees. What other, maybe some, not our employees, our residents. Maybe some residents had to pay surcharges because they weren't able to use the elevator, stuff like that. Now, those are very difficult to quantify, I admit.
Not if you
But
publicize it, by the way, in the building.
Pardon?
Not if you, in the next board meeting tonight, even you come up and you say, hey, listen, anybody who had any issues, who had any expenses or anything like this from this period of time to this period of time that occurred due to delays or whatever it is, it'll be very easy to get a hold of all this information.
Maybe it is. So that's I think where you're coming from, David. So is it something we should do in preparation for, I think what will be, no party's ever going to admit that they're solely responsible. So they're going to come back and they're going to try to whittle down that 100,000, whatever it is. And we gotta, I guess it'd be good to have a counter argument to that saying,
Yeah.
you know what? You're getting away with murder here because it's not 100,000. It's like cost us 500,000.
Can I share something?
Yeah.
Brooke Barrett here. The whole idea with liquidated damages, by its definition, is that it provides compensation for our damages. And so we have to be careful when we start talking about it as a penalty, because it's not supposed to be a penalty. And that's one of the problems you have if you try raising it up past a certain point. Like, let's say we are all of a sudden to decide we want to charge $2,000 a day. Then you get into that whole business of, okay, how can you substantiate that that's what your damages are? And you get into these kinds of soft econometrics. But what I've typically seen is that if we come and say, okay, you were supposed to be done 9 months ago, and let's pretend we're done now. And so we say you have 9 months of liquidated damages. Typically what I've seen folks argue is they say, well, that's not really true because, but for the 3-day party you guys had, Playa del Sol Mardi Gras racetrack event, and you told us not to bring the crane in for 3 weeks, you can't really. And so that's what I've seen in the construction business when you try to enforce that, is then they come up with a whole litany of delays they've had. I've just never seen it. I'm not saying it doesn't happen, but I think if we were to compile all this stuff, I wouldn't see it being useful for us in the future. But since I do econometric modeling for benefits of hypothetical flood events and things, I mean, I think it's an interesting concept, but I think you guys would be putting a lot of effort into something that may not be useful. Thank you, and I apologize for.
I also want to mention something else. The minute we start asking the residents, how much damages did you have, the residents can also come back and say, okay, I need to get paid for those damages. So I probably would just stick to the contract and take it from there and see where we are once we start negotiating with them.
Okay, well, I think we've had a lot of good discussion, a lot of different viewpoints on this. They're all appreciated. So we'll follow what Katina's saying and ask you as you get forward if they contest the damages as per the contract, then it's for us to defend those tooth and nail. All right. So just quickly here on the last page, because I don't want to take up the whole meeting on this. We only have 25 minutes left. So there's a special assessment part. There's a SERS reserve fund. So we've started the year at 3.567 million. We added 956 in reserve additions. We've added 400,000 in interest, and so far the expenses, subject to final confirmation once the adjusting entries are in, have been 30,000, quite insignificant so far. So we're currently sitting at a balance of 4.9. For the non-service fund, we started at 1.284, added in 233,000 from the assessments. We're at 1.5. So with the pooled funds again this year gives us, starting this year, gives us more flexibility. So we don't have to allocate line item by line item.
Good.
Okay, so with that, I'll go back to the agenda if I can find it. So that was the point number 2. Point number 3, the 26 budget discussion and planning. So what we did last year for the benefit of the Finance and Insurance Committee meeting members and whoever else is on the call. I think, correct me if I'm wrong, Heskey and Scott, but you each prepared a draft budget, and then we compared it to and started the ball rolling with that. Is that accurate from my recollection? And 2, is that what we're going to do this year as well?
Yes, that was accurate. Me and Heskey both compiled a budget and kind of just went over it with each other, you know, comparing what we had prices in for each line item and the reasoning for, you know, the prices. And I'm fine with, you know, drafting one again if, you know, and then if the committee or Heskey or whoever wants to draft, you know, a second one, and we just kind of do the same thing, compare notes and find reasoning for why we're coming up with.
Okay, so what I suggest is we do the same, and then I'll call a special meeting just to review the budget once we have the first draft available.
Yeah.
The other thing I was thinking of was that for our next meeting on October 2nd, I was going to invite Tim Renfro to give us an update on the insurance market. You know, we had quite a few discussions with him in April and May, but just to get his perspective on what's happened in the marketplace from an insurance perspective over the last few months, and more importantly, how he sees things evolving heading into 2026.
He actually expected another 10% drop in property premiums for 2026.
Right.
And something for Scott, for you guys all to be aware. All right, so Scott, the new security officer, the manager, is his pay higher than Chris?
Hit $3,000
For
That's
what?
good.
for annually.
Okay,
That's
but
not bad.
we're also hiring a building engineer now, so that's a new position that we're sort of creating. So that's going to be another 80,000 a year.
That's 95.
95.
But is that going to cut the contracting work that we currently do? I mean, we have a lot of external contracting work. So does the engineer gonna?
He's not a worker, no. Sorry.
What's the
Then-
But
engineer?
I still, when you hire a good project or engineering manager, they're going to pay their own salary many times over.
Exactly. So it shouldn't
By
increase
finding
the
savings,
budget.
by finding economies of scale or whatever
Yep.
else. Let's not just look at it from one perspective, and we're going to add in 100,000.
Right.
Well, because we're
Exactly.
not, you know, and that's fine. We have to because we know that's a commitment that we have. But there should be some upside in terms of savings.
Why is that a commitment we have?
Well, because if we're engaging somebody to come on board, then we have to pay them, right?
Yeah, but if we don't have the budget, first you approve the budget,
No,
then you
exactly.
hire.
But that's
So-
what I think we're discussing, Katina, is that we're highlighting things that have to be included in the budget at this point.
And then the second thing is, I think the reserve study had a slight drop.
And just let me backtrack for a second. I think this manager was approved by the board, wasn't he? This engineer, sorry?
Yes.
Okay, so there is a commitment there, Katina.
Okay, so
What's
I
the need
assu-
for the engineer?
Yeah.
Why is there, what's the objective or job
Yes.
description?
Well, I think that was discussed at one of the board meetings, so
Well-
we're not gonna go over that here because I don't think I don't have it. Heskey, I don't know if you want to say.
I mean, if you notice on Scott's report, there's so many items that, you know, were left neglected. So the engineer, I mean, we offered the job to Dotson. Dotson said, no, I don't want to be a chief. I want to be the worker. So when we needed to hire somebody to supervise our building plant to make sure, you know, we're keeping up with maintenance. I mean, Scott's been doing it for the past year and a half, but he's gonna get pulled in different directions, and things are gonna, you know, fall by the wayside. So, no, we want a regularly scheduled maintenance regimen for the building. So things don't get into the same situation as we're in now. As far as like the paver decks, we could have avoided a lot of these costs, and that brings me to Sean Flynn's comment about the reserve studies. If you do maintain certain aspects of the building properly, if you maintain it properly, then you have a longer lifespan for each. If you patch up the roof, if you paint, put a new coat of silver paint on the roof every year, you patch up the leaks and you maintain it, or you maintain your equipment properly, and you oil it, and you change parts, and you know, you paint, prevent it from getting rusty, it's going to last longer than what, you know, the original life expectancy was. It's just like if you're a healthier person, you're going to last longer too, right? So that's how we're going to get our money back.
By the way, Dotson is not an engineer, right?
Pardon me?
Dotson is not an engineer.
No.
So when you say engineer, you don't mean someone who's a certified engineer. You mean someone who is maintenance person.
Yeah, maintenance
Okay.
supervisor.
That makes sense. Okay.
They
Okay,
call
okay,
them
that makes
building
sense.
engineers. Yeah.
Okay, fair enough.
No, we're not talking
I
about.
know. I'm an engineer, so when you say engineer, I mean engineer.
And
You cannot use that term lightly. When I was working for a company that had 3,000 engineers, and if you're not an engineer, then you can't say you are.
Well, they also don't cost 100,000.
That's also true. That's why I was surprised.
That's true.
Yeah.
Okay.
All right, thank you.
So just to be clear on the budget, so we'll get the draft going. Then I'll call a separate meeting just to review the first draft of the budget. And at the next Finance and Insurance Committee meeting, I'll invite Tim to give us an overview on the marketplace related to insurance. And that'll serve obviously as input to our to our budget, because on the operating side, I think the insurance part is like 30% of our budget anyway. So if we nail that, then we got, you know,
Then
and
the other
salaries were like 80% of the budget, or 90.
The other main question is, what level do we maintain our reserve contributions? Do we go by the recommended amount in the reserve study, or do we keep it flat with what we have this year?
I would follow the reserve study.
Yep.
That's the law, pretty much. So as far as
if we do better than the reserve study by maintaining it,
then I would keep it to okay. Even reserve studies are objective, subjective. They're not objective. They're all subjective. So you can be plus or minus. So, you know, I would not be, unless it's a major variance, I always go with the conservative side to keep it on the plus side than the minus side. But after we do it, we understand what it is, we can make a decision.
Also, reserve study should take into account.
Much.
Sorry, go ahead.
It's not going to vary by much, you know, by tens of thousands. Not.
Yeah, so I don't think we're talking anything material at this point. So I would
philosophical. Do like Sandra says, do we just say we stuck with the reserve study? The reserve study, look here, line 3, it says this amount, and that's what we did.
Correct. It's 1689 versus 1640. You know, it's 50,000 more. So it's not that big of a deal over 300.
Also, the reserve study should take into account maintenance, I'm assuming.
Correct.
Yeah.
Okay, so we're on item 4 of the agenda. Any other business? And I think you touched on this, Heskey, and related to the cooling towers and the riser. And Sandra put a little small presentation together, one pager. So I'd like to just have a general discussion. I forwarded the information to the Finance and Insurance Committee members. So I'll bring that up and we can have a discussion around it. I mean, they're valid points made, but so can you see what's on the screen
Yeah.
here? Okay, Sandra, maybe just lead us through what you did here and after that we'll discuss it.
I kind of just summarize the projects that we are currently working on, the projects that are coming up between SERS and non-SERS with the amount that is included in the current study. So kind of like a budget amount, if you will, and the year where we anticipated the project, where the study anticipated the project to occur. So a lot of them are, 2025. So risers, pavers, planters, and then we've got some monies in there. But I guess the one question was on the cooling towers, as this was anticipated to occur in 2032. So I guess that advances that project and spending that money ahead if we in fact go ahead and with the cooling towers.
But my question,
just before we have a discussion on it, I think there was a discussion at the last board meeting. I wasn't there, so I don't know, but maybe Heskey and Scott, you can just summarize what was discussed related to that prompted Sean to send his email, because so then that'll give us a level set and put us all on the same page.
Background, yeah.
So, we have our roofing project, right? So then the issue came up is, well, you're going to have to replace this cooling tower, and you don't want to replace the cooling tower after you spend 2 million plus on the roof. So that's what's really sort of driving the cooling tower project a little ahead of schedule, is because until we do that cooling tower and replace all the steel that's holding up the cooling tower, that's called the dunnage, and all the construction that's going to go up on there. We don't want to do a new roof until we do that. So that's what sped things up. The engineer comes and says, hey, so you're doing a roof, but 2 years later, you're going to destroy your roof by replacing this cooling tower. I don't think that's very smart. So that's what really accelerated this whole process.
So even though there might be some remaining useful life in some of the
cooling tower
projects, because of the sequence and the impact, it might be better to do them sooner than later.
Right.
Well, on top of what Heskey said too, we had the engineering company come out and do a feasibility study on our cooling towers, and they were telling us we're pretty much right at the end of the life expectancy of the towers as well.
Okay.
That's for the
But
condition.
hopefully in the reserve study, there'll be some items where the life expectancy is maybe just a bit greater than what they estimated.
Well, the roof's holding up. The roof's going to held up an extra 3-4 years.
Right. So hopefully those things will kind of balance off.
The risers are holding up. The HVAC units are it's holding up. And we're replacing a lot of hallway HVAC units. It's not, we're not doing all hundreds of them at the same time. So we're replacing them.
Which was anticipated actually in 2025, many of them, and we're not doing. So, you've got some pluses and minuses.
And that's the best thing that we ever did, financially for the building, is to go on a pooled reserves. And it doesn't tie our hands behind our backs. It gives us flexibility on when to spend money, on how to spend it. And the longer the projects, we can put off the projects, the more we build up our war chest, and the more we can not hit owners with special assessments and just we can, you know, just keep our contributions consistent and level, we can fund all these projects, including the ELSS and the BDA. And you missed the sprinklers. We have to add sprinklers to the building. So, no, with our current level of funding and with the extended timeline that we see, which is 3 to 4 years, we can actually fund everything without having to resort to a special assessment.
Okay. I mean, I agree with the roof and the cooling towers. I was in charge of a large facility and we delayed. We had air conditioners on the roof. We stretched the heck out of them to have them equal life because you got to replace them all at the same time or else you damage your roof again. But even with all these projects that were coming up, just because we finish them whenever, and I would prioritize based on what needs to be done first, but we still have to continue with building our reserves because
For sure.
in a sense, we depreciate the minute you start with a brand new project like the elevator. In 35 years, that elevator is dead again. And in a sense, we have to depreciate each one of these projects and fund the reserves again. So when we're ready to do it, we have the money available.
Yeah, that's why we got to maintain our, our payment at this level, which is what the reserve study projected.
Good.
We're going with the amount that the reserve study says. At the end of 30 years, we're going to end up with 100% fully funded reserves.
May I speak for a second here?
Yeah.
I talked to Husky about this one-on-one, and I don't want to take up too much time of your time right now, but I've looked at the reserve study and Vince has looked at the reserve study. And I mean, I even have an email that went to the board from Vince, although I'm cautious when I quote people. But we have some problems in our reserve study. And part of it is that our reserve studies are subjective. And unless we really tell the folks what we want to do, you typically have somebody who's very early in the career, is often being handed this because it's a contract requirement or whatever. And so, I guess my main point is this. We have in-house talent who can help you get our reserve study where it wants to be.
Right.
I know there's a lot of people in the swimming pool who had hoped that our contributions were going to go down this year. I mean, I don't want to get into who said what when, but there was this notion that we had broken apart a special line item on, and that it was going to go up, be there 1 year, go up the next year, and then we'd finish these projects and it could go back down again. And there are a lot of people who are disappointed about that, some who are angry. I'm okay with it remaining the same, but at the same time, it just bothers me if I feel like we're just saying, okay, the law told us we need a reserve study. We hired a professional to do our reserve study. We kind of like the number in the reserve study.
Hold on. First of all, we got 5 minutes left in this meeting. We get your point. The reserve study is not to please anybody. It's to give us an estimate. It's predicting the future.
Anyways,
hold on a second.
Hold on a second.
Let me finish. I'm chairing this meeting. Hold on a second. The reserve study is there to give us an estimate. Nobody can predict the future. Is it perfect? Of course not. Will we solicit input from others? Absolutely. It's a work in progress and we'll get it done. That's the reason and one of the mandates of the Finance and Insurance Committee meeting. And we certainly appreciate your participation and your input, and we'll work on making things better.
And that's what
having said that, I have 5 more minutes here at the meeting and I have to use it for something else. Thank you. All right. Any other questions on this?
Yeah, the one thing I just noticed is BDA. We don't have the BDA in either of our reserves. Right now, it's a reservable item.
Scott, is that not the fire alarm system, or is that something different?
It's
different.
something different.
Oh, so I had it. Okay, so then it's 0 there. Okay, so that's another thing that's not funded then.
All right. So I want to conclude this meeting as scheduled at 4 o'clock. I have one more item that I have to review, and those are the minutes. I neglected to do so at the beginning of the meeting. So these are the minutes from our last meeting. I just want to highlight general discussion we had on the condo values. And at that meeting, we said that we would reach out to Fannie Mae and Freddie Mac to see what was available. Scott, you did that.
Yeah.
Maybe just summarize what they came back with. I mean, when I read it, it wasn't anything great, but at least it's some sort of.
No, I mean, it was just basically they said that they didn't have any information on our building that would deny, somebody from getting a loan. I think they basically collect information off of condo questionnaires, and that's how they compile their list of negative items for buildings. If we're not funding reserves enough or we have inadequate insurance, that gets put into our Playa del Sol file, and that's the kind of stuff that gives us the black mark or red mark next to our name. But there's for both Fannie Mae and Freddie Mac, it was basically they didn't have, negative information on the building.
Okay, good. Thanks for following up on that. And we'll use the last couple of minutes here. Any other questions from the Finance and Insurance Committee members?
Pam Valeria has a question. Do
Yeah.
we have any quotes on the ELSS? Did the board get any quotes so that we would know a ballpark figure for budgeting?
Yes, so we have quotes for the sprinklers, the fire alarm system, the BDA. I'm sorry, I'm trying to think what else.
That's okay. I'm just this would give us an idea of what we need for our reserves as well.
Yeah. So we do. Yes, we have estimates. We have amounts for those, and those will be input into our budget cycle.
Yeah, I have those figures.
Great, thank you.
Our project manager is trying to get one contractor to bid on the different aspects of the fire safety systems. So rather than bringing in 3 different contractors, we want one contractor to do the BDA, the sprinkler system, and the fire alarm system. So this way, they're not going to have any internal disputes about he said, she said, that's not my job, that's his job. And
Great.
Okay, so with that, I'm going to call an adjournment to the meeting. I'd like to thank the Finance and Insurance Committee members for your work and your participation, and count on your ongoing support, especially as we go into the budget cycle. And I'd really like to thank all the residents or the owners who took time to listen in to today's meeting and provide their feedback.
Hey, Mike, can I ask, do we get the budget earlier so we have an opportunity to review it before our meeting?
Send it to you.
Okay.
Yeah, so what we'll do is when you send it, Heskey, then I'll organize a call or a meeting, let's say a week later, so that you'll have time to kind of reflect on what's in there, and then we can have a more productive meeting when we do have that budget meeting.
Good. Thank you.
Thank you.
All right, and see you all
Thank you, everybody.
on the 2nd of October.
Thanks.
Take care.
Bye.
Thank you.
Thank you.
Bye.
Bye.